This is The Markets. I'm Chris Hussey, and today is Tuesday, March 3rd, and I'm here on the Goldman Sachs trading floor with Jerome Dortmans, who is co-head of global oil and products trading. Let's cut to the chase. Oil's up about $10 a barrel since the Iran conflict started this weekend. What do you make of the move?
Good question. We've actually, in my opinion, given what is going on the ground, have had somewhat of a subdued response on the oil price. We've had precedents over the last sort of 8 years where every time something like this happens and the market starts to fear sort of a contagion or a spread to the region, it hasn't really played out. And anybody that invests in getting long, has ultimately had to take the pain and had to sell out. This situation is clearly very different. We are definitely seeing, oil barrels being affected. And just to give you the amount that is at risk here, it's 20 million barrels a day on crude, and it's up to 5 million barrels a day on products, which is obviously and 20% of LNG production. These are meaningful and unhedgeable volumes of oil.
The world only produces 100 million barrels a day,
Yeah.
so 20 million is like 20% of the whole oil.
Yeah, and this is the first time, that the barrels have actually been impacted.
Yeah.
Fine, it's 4 days right now, 5
Right.
days. So obviously,
Well, let me ask you about that, because it is only 4 days so far. I would imagine how long this lasts has an impact on this as well. How do you factor that into markets? How are markets thinking about how long?
Yeah, again, true. The issue is that if we are talking about up to 20 million barrels a day of production that is affected, the reality is there are paths. There's a pipeline that can take oil from the east to the west of Saudi, up to 5 million barrels a day. There's a pipeline that can take you from inside the Persian Gulf to outside to Fujairah, but as I said earlier, that's already been attacked. So the ability to continue those flows, again, may well be constrained. But if we're talking about these kind of volumes, every day matters. If we are losing that kind of volume on a daily basis. We built stocks in the second half of last year. This will eliminate that stock build very, very quickly. And there is no meaningful response to that kind of volume. OPEC can't increase production. And even then, the production is part of that is inside the Persian Gulf, so it can't come out anyway. So it doesn't, this morning, again, just as a tidbit, Iraq has had to shut in production because their storage is full. And so that's the next level of a problem. So I think we are getting very close, to a situation where we need to try to resolve this choke point. The U.S., Israel, the market has to try to solve this sooner than later. It can't just, because the contagion and the domino effects on other parts that are not being affected by Iranian activity are real and meaningful. So I think another 2 or 3 days, this becomes a serious issue. And whilst we are, now trading $84 oil, as we go towards that 2 to 3 days, we will start trending towards $100 a barrel, because it's every day that goes by is more meaningful in terms of the impact, I think, on the oil complex.
Yeah, these spot supply commodities like oil, they just work differently than a stock or something like that.
Yeah.
If there's nowhere to put it, what do you do? Let's drill down a little bit more, because, products as well, because that in the end is what hurts an economy. You've got diesel, you've got jet fuel, you've got regular gasoline. What's most at risk here with what's going on?
Yes. So the most impacted in terms of products is definitely the diesel and the jet fuel. A few reasons. One, that region is a diesel producing machine. The U.S. refinery complex, by example, is a gasoline producing machine. The Middle East, has been built to be a diesel producing machine. Jet fuel is whilst airports have been shut, which obviously is going to temper demand in the short term, there's a high dependency on jet fuel supply from the region, especially for Europe. So jet fuel, is a major impacted product. The other, I would say, more impacted products are on the light ends, not gasoline, just because it's not a major producer of gasoline, but LPGs or NGLs, petrochemical feedstock is a major impacted product there. The Iranians are also a big exporter of those feedstocks and a big exporter of condensates, which also act as a feedstock to plastics production downstream. So those are probably the three biggest impacted. Fuel oil is also impacted because when you hit a refinery in Saudi, they are a big producer of fuel oil. So that market has also seen a reasonable appreciation.
Okay, broaden it out even further. The markets now, it's not just the commodities markets getting hit, other markets, the stock market today, under a little bit of pressure. As you see investors in this fairly constrained commodities market relative to a stock market or a bond market, are you seeing people come in to try and hedge exposures to global growth at this point already?
Yeah, it's a good question, and it's the one thing that has maybe surprised me a little bit. I think because of what has been happening over the last few years with these geopolitical events, as in we see the spikes and they very quickly come off again. So in my view, there's a decent amount of complacency here. So we've not seen that. In fact, we've seen a lot of profit taking and a lot of investors thinking, we're now so far away from fair values. This is not going to last forever. This is probably a window actually to look at positioning to the downside. And, I can see the arguments for that, obviously. But, if I look at the next 36, 72 week, maybe even 2 weeks, I think that's a risky proposition because we are seeing material impacts on price inflation across the oil complex, into the petrochemical complex, into, all the industries that are obviously dependent, car industry, whatever. It is broad, as we know, the penetration of hydrocarbons. So I think there's a little bit of complacency here, and I think it is betting, that the pain, in terms of what the oil market does and its contagion on others will at some point be addressed, by the market or by the U.S. administration.
One of the unique things about oil, too, though, is that ironically, the U.S. has all the oil it needs. I mean, it can produce, it's self-sufficient at this point, but it is a globally priced commodity. How does that factor into, you think, U.S. policy around the oil sector?
Yeah, this is an excellent question, and we've been discussing that this morning. 20 years ago, when the U.S. was the short in the market, this would have been a very different discussion. The short in the market today is China and India. It is their problem, effectively. Now, obviously, attacking Iran, by the U.S. and Israel is a problem created by the U.S. and Israel to a certain extent. But ultimately, they're not the ones that are going to feel the pressure, from the shortage of oil. I'm not saying that they're not going to act to help alleviate the burden or the issue that could arise if this is sustained for a period of time. But I don't necessarily see them as being the first mover. I think, if there is a coordinated IEA effort to try to soften the blow of obviously the supply issue, the U.S. is part of the IEA mandate and, of course, will do what they need to do. But I don't think the conversation in the U.S. administration is necessarily going to be focused on how is China feeling about what's going on to the extent that it would have done in the past when it was a real problem for the U.S. refining system when they were importing 9 million barrels a day. I think the calculus has obviously changed.
No, that's such a good point. Okay, what's the trade then?
Yeah, in the short term, I can't look beyond, focusing on what's happening on the ground. We are still in full escalation mode. We have not seen the full impacts on price, in my opinion, just yet. So as days roll forward, trading from the long side across the oil complex has got to still be the bias. But of course, this has to be tempered with, this could stop at any minute. If objectives have been achieved, and I'm not a military expert, I don't know what all the objectives are. I don't know to what extent they are being achieved, how far along we are in this operation. But once they've achieved what they think they want to achieve, and it stops, I think then we can see obviously a reversal. But that's not a given to me that Iran stops. once the U.S. stops, because they've obviously been completely decapacitated. So, there is still a risk that we see a situation unfold that we saw years ago in the Red Sea, where there is continuous disruption. But it won't be to the material impact that it's having now. But it doesn't completely go away. But I think watch what's on the ground, and then at some point, start to see signs from the U.S. administration about how far along they think they are, or how far they want to continue to take this. That is something that the market is clearly, a bit cautious about because of how quickly last June this thing ended. Sure. So, but I think you've got to just continue to trade the facts on the ground, and the facts on the ground are constraining supply and affecting supply in a real meaningful way. And I don't think, certainly not the crude price, is fully factoring that in.
Yeah, the standard commodity trade, if you're short supply, you buy the commodity.
Yeah, that's certainly where my bias is.
If I want to be long oil, how high do you think oil can go?
I think if we continue to see this escalation continue the way it is, and as I mentioned earlier, as we're going into a longer period, there's no reason why we should not be trading between $100 and $120 oil. That to me, if the Straits of Hormuz stay shut, that has to be where the price has to go.
Jerome, thanks so much for taking the time with us.
No problem at all. Thank you.
That does it for this week's episode of The Markets. I'm Chris Hussey. Thanks for listening.
The opinions and views expressed herein are as of the date of publication, subject to change without notice, and may not necessarily reflect the institutional views of Goldman Sachs or its affiliates. The material provided is intended for informational purposes only and does not constitute investment advice, a recommendation from any Goldman Sachs entity to take any particular action, or an offer or solicitation to purchase or sell any securities or financial products. This material may contain forward-looking statements. Past performance is not indicative of future results. Neither Goldman Sachs nor any of its affiliates make any representations or warranties, expressed or implied, as to the accuracy or completeness of the statements or information contained herein, and disclaim any liability whatsoever for reliance on such information for any purpose. Each name of a third-party organization mentioned is the property of the company to which it relates, is used here strictly for informational and identification purposes only, and is not used to imply any ownership or license rights between any such company and Goldman Sachs. A transcript is provided for convenience and may differ from the original video or audio content. Goldman Sachs is not responsible for any errors in the transcript. This material should not be copied, distributed, published, or reproduced in whole or in part, or disclosed by any recipient to any other person without the express written consent of Goldman Sachs. Copyright 2026 Goldman Sachs. All rights reserved.